The title of the presentation is How Effective is the Nigerian Oil Price-Based Fiscal Rule? You can get some information about me from what we have under the title. I'm a PhD student here in the UK. The objective of the study is to examine the extent to which the fiscal rule has achieved its objective, which is basically the reduction of domestic volatility that is rooted in the oil-driven nature of the Nigerian economy. It is widely accepted in the literature that Nigeria is an oil-driven economy. To explore the extent of that effectiveness or of the effectiveness, there is a policy comparison done between Nigeria and Norway. So that is part of the objective. Now, there is a diagrammatic demonstration of the problem that was existing in the economy before the rule was introduced. The volatility is usually transferred from the oil market, international oil market. You know, one of the attributes of oil is the oil price volatility. So the volatility is transferred from the oil market to the domestic oil revenue and to the government expenditure, then into the economy. The reason for that is that the economy depends largely on oil, so the expenditure is heavily linked to oil revenue. So the solution that was designed to be achieved through the fiscal rule is to set a domestic reference oil price. The reference oil price is to be set annually. So through that, there could be oil revenue smoothing. That is, there will be a limit on expenditure set based on the reference of oil price, so that when oil revenue is high, or when oil price is high in the international market and revenue is high as a result, there will be the saving of the excess revenue. There is a special account created for that, so that when oil price goes down and oil revenue consequently reduces, then withdrawal can be made from the account. So from this picture, we could see that the main solution strategy of the fiscal rule centers on delinking oil revenue from, delinking government expenditure from oil revenue, creating a divorce. Creating divorce between the two, as you can see from my pictures here. You can see the picture of divorce. So we could quickly look at the literature and see some studies that are related to this. There's a study of Okonjo-Iweala that explores reforms in the Nigerian economy. And one of the things touched in that study is the effectiveness of the fiscal rule. Then there's a study of David Nello on some sub-Sahara countries that have the features of emerging markets. Nigeria is one of those countries. And in that study, the author makes mention of the fact that the oil revenue, the fiscal rule has been successful. So, we also have the study of Hebel, Hebel, on the Norwegian stabilization reform. Then the study of Boye on the same Norwegian reform. So these are the data used in the study. Annual data on revenue and expenditure. Then quarterly data on GDP and the global oil price. The comparison of the Norwegian policy and the Nigerian fiscal rule is done with the quarterly data, while the relationship before and after the fiscal rule was introduced is done with the annual data. Now, I would have preferred to use quarterly data. I have many number of observations concerning, on the study of the relationship between the oil revenue and the government expenditure, but I couldn't get quarterly data on those two variables. So, the variables are used in their real terms using price deflator and CPI to deflate them accordingly. So the results are as follows. These are the unit root results. All the variables are stationary after the first differences. Then I have employed standard deviation, correlation, and variance to see the association, the co-movement, and the volatility of the variables before and after the rule. So the results indicate that the volatility measured by the standard deviation has reduced after the rule. Then the correlation after the introduction of the rule has come down. Then it is even negative. The correlation is negative, indicating negative association between the two variables, oil revenue and government expenditure after the rule. Then the co-movement explored through the covariance is also negative, indicating the effectiveness of the rule. Then I've done a quantitative regression of the two variables, and I could see that there is a long-run relationship between them. What I've done with this is to do a child test. Now, the quantitative regression here involves three variables. I've included the non-oil revenue so that I could see what really happens between total revenue in the economy and government expenditure as a result of the introduction of the rule. And I have used this regression to run a child test, and the results indicate that there is a structural break in 2004 when the rule was introduced. So to confirm that there is co-integration between the three variables, I've done the unit root analysis of the error term of the regression. Then here I have concentrated on the government expenditure, and I've used the three variables. I was thinking I used the three. I used two variables. I've used two variables. In the dummy analysis, oil revenue and government expenditure. I remember I excluded the non-oil revenue. So, and I've employed the dummy variables to see how the dummies interact with the regressors. So have the intercept dummy, have the slope dummy. So according to the results, the two dummies, intercept dummy, slope dummy, are statistically significant, indicating that there is a structural break. That is further confirmation of the structural break. Then I have explored the error correction mechanism between the oil revenue and government expenditure before and after the rule. So I have two samples, 1970 to 2003, 1970 to 2010. So from the results, it is clear that the oil price-based fiscal rule has been effective in limiting the relationship or the link between government expenditure and oil revenue. They have explored the GACH model to explore conditional volatility. And there are two GACH models. The first one is without a dummy variable. As shown here, there is volatility clustering. Now, there is the inclusion of the dummy variable in the second GACH model. As we could see, DU as is one of the regressors. It is statistically significant. The DU points to volatility break. It is a dummy created by ascribing 1 to the years of the fiscal rule and 0 otherwise. So the dummy variable is statistically significant. Volatility break is statistically significant, indicating that the fiscal rule has been effective. So to do the policy comparison between Nigeria and Norway, I have employed the GACH model. And from the models, this is the Nigerian model. This is the Nigerian model with dummy. You could see also that from the first model, there is volatility clustering. Then when the dummy is included, the dummy is still statistically significant, indicating the effectiveness of the fiscal rule. Now, the first GACH model for the Norwegian economy indicates volatility clustering too. So when the dummy for Norway is included, the Norwegian dummy is to explore whether the reform introduced in 2001 in Norway has been effective in limiting volatility. As we could see, the Norwegian dummy is not statistically significant yet, so it has not been, the reform has not been effective in limiting macroeconomic volatility. There are many aspects of the reform, but I have concentrated on the issue of macroeconomic volatility. These are the unit rule tests to explore co-integration between the variables of the GACH models. So the main findings are that the Nigerian oil price-based fiscal rule has been effective, and the studies of Eregha and David Neno confirm this. Then the Norwegian reform introduced in 2001 has not been effective with respect to the limitation of macroeconomic volatility. And the study of Boye-Hef, 2011, confirms this. So these are the basic things about this study. Thank you very much.
Okay, I'm the discussant, so I will just briefly raise some issues. In the first place, the basis for Norway and Nigeria, I don't know, in the work it's not well explained. However, the topic looked good and almost everything presented is good, but the key issue I want to, when I read the work, is that the basis you provided, is not really a basis. How do I say that? If you look at Nigeria introduced that rule, and Nigeria rule of saving money, what the sovereign funds or whatever name they called it, they actually never implemented that rule. Because the government said, it came from the federal government. The federal government said, so amount of excess crude oil should be saved to stabilize the economy in the future. But there was this called the Governors Forum, told the federal government that by the constitution, whatever thing that comes into the government should be shared. That is our constitution. And the constitution said that whatever thing that comes to the federal government should be shared. The federal government should not have anything in its account. On that basis, they were not having any savings for the tomorrow. So it becomes, they are basically two different things. Okay, so the question I now ask is that that kind of a thing where the policy never, whenever it was a good policy, but it was not implemented, will it have effect on volatility corrections or whatever thing that the work is actually looking into? Then I leave that issue and I move to, your literature. When you were presenting, you presented some literatures, but in the work I never saw literature. I was just looking at your section 2, and you're basically just talking about factors that could be responsible for Nigerian volatility. And you were mentioning those factors. I would have loved to see from theoretical argument and empirical analysis argument, these are the issues that were raised on the literature, based on literature review and literature survey. And that would justify these factors that are basically, just mentioned in this place. Then, even your section 1, there's a section in your section 1 where you were telling us your method of analysis, and I put it there. I said this should be methodological issue. For instance, you said in your section 1 when you were discussing standard deviation, autoregressive, and all of that. These are methodological issues, but they are under your section 1. Probably they should be moved to the normal section, and tell us why these methods are basically applicable in this work. Then when I read basically the introduction, I couldn't find the problem statement. What is the problem statement? Problem statement basically has to have two basic issues. What is the economic issue? And basically, what is the research issue? I basically couldn't find it, but when you were talking about implication of your results and all of that, it sounds nice that a study like this should be carried out. But when I was reading the work, basically, these issues were not really buttressed. So that is on that. Then I go to your results. You presented your first results is unit root, and it says that all your variables were I1. Then the second one was standard deviation. That is okay. The next regression I saw was conjugation regressions. When your variables are I1, the next thing somebody should expect to see is to see whether these variables are conjugated in the long run. But that was not the result you presented. What you presented was just a normal OLS result, which in that case should be a superior regression. So probably you should test for conjugation, and after conjugation being tested before you present your error correction. So after that, your conjugating regression, the next thing I saw was the error correction, which should have been the case because these variables are I1. But it was after your GAC test and all of that I now later saw how do I call it? One of this thing there is, you now use how do we call this method now? The Engogranger conjugation test, where you tested for unit root of the error term. Maybe that should have come immediately after your unit root before you now present that and go ahead and present maybe the error correction. But that takes me back to your GAC. Or to your model. Basically, maybe based on your literature. The literature should lead you to the model to estimate in this case. Because you are saying that government expenditures is a function of revenue. And by Nigeria case, where the revenue that comes in is basically shared at all, you find that your result, almost all of them will be very, very significant. Because we even spend more than what the revenue that comes in. So your result will basically, it's going to be positive. In fact, all your results are so positive, they were all having positive and significant effect. Then what is now the intuition of that result? And everyone will consider the theory of balanced budget multiplier, where what we receive is what we now spend. I think that government expenditure is almost the same thing as revenue, if you put that kind of a model. So if you are talking about macroeconomic volatility issues, probably you look for other variables that could capture macroeconomic volatility as a function of probably the oil price shock that is coming, and that is why I want to probably put it in this way by saying that, if possible, you talk about the channel. Maybe you presented a channel, and from that channel, build a model around that, and how oil price volatility comes down to affect macroeconomic variables by that channel, and build your model around that here. That will basically give us a better result. Then your gap regressions, I was just trying to look at it. Even when you introduce the dummy in your GAG, your R square in all of the two of them are the same, 0.29. It then implies that the introduction of the dummy variable does not even have effect in terms of explaining why that GAG effect is established. Because in the previous relation, GAG effect was established. When you now introduce the dummy, the R square is still the same thing. So it then implies that it does not really basically have an effect. Though it has a negative distance, which you were trying to explain that is the reasons for why it passes through to government expenditure. But to me, since the two of them are the same, it does not explain its inclusion in that place. On that note, I want to say thank you, good presentation, and others to comment. Thank you. So the floor is open.
I'm Saeed Olaiwola. Yeah, thanks for the presentation. But my concern is just about, my first concern has to do with the structure of the two economies that you are trying to compare. I don't know, you said from the main finding that Nigerian fiscal rule has been effective. And I asked myself one question. In the history of basing the the expenditure of money on oil and price in Nigeria and saving the excess crude oil, if you trace the history of Nigeria, you find out that most of this money being saved always at the end of the day, got into a private pocket. Yeah. Those in government, directly or indirectly, ended using those money for their private, for their private benefit. So the question, I don't know, and again, you quoted Okonjo-Iweala here by saying that physical rule has been effective. So Okonjo-Iweala, she happened to be a World Bank scholar, but then presently, she's a politician in Nigeria. And when a politician talks in Nigeria, you think twice before you accept what he or she says. So, Okonjo-Iweala, in one part, will be talking as someone in government, a politician, and in another part, will be talking as as an expert, a technocrat. So, I don't know how we can actually use this as the basis for your conclusion. And again, the Norwegian economy that you also use to compare, I don't know whether the same situation obtained in Nigeria was also obtained there. So this, that's the first thing, I want to point out. Another thing also has to do what does this transfer? The findings there. Well, then what is the implication for Nigerian economy? What do we want to gain from this, from this finding as a country? Thank you very much.
Okay, I'm Solomon from University of Ghana. In fact, I think my only concern has to do with the transmission mechanism. I think the researcher simply assumed that once there's volatility in the government revenue, automatically it impacts on the volatility of the macroeconomy. Because he said that whenever there is volatility in oil revenue, it affects the volatility of the entire government revenue and subsequently affects the volatility of the macroeconomy. But I would like to know if it's always straight or it's always direct. Do you always have that effect? I was thinking that perhaps we could have estimated the volatility of government revenue on the macroeconomy, first of all, to find whether that relationship is already causal, but it was assumed. I don't know whether it's clear. You made the argument that from the chart you showed in one of your slides, that anytime there is changes in the world market price, it affects the oil revenue, it affects government revenue, and eventually affect the macroeconomy. it looks more of assumption than something you really tested. You did not let us know the extent to which volatility in the oil revenue eventually affects the volatility of the macroeconomy. And I think that's my concern.
Thank you. I'm Thierry from University of Yaoundé, Cameroon. Thank you for your good presentation, but I have just a little concern about the methodology, the model. How do you justify the use of the co-integration regression in your paper? And also, can I see the results? Because there is a problem about the result on the result of your paper, the last.
Which one?
Where is the Durbin Waston?
Durbin?
The Durbin Waston.
Durbin Watson.
Yeah. Yeah. Your result. Your Durbin Waston. Yeah. The W was done in less than 2%. Is 0.2. The coefficient of the W was done less than 2. Yeah. Can you explain why your W was done less than 2?
Yeah, the Durbin Watson for the GATCH HEM models for the two countries indicate positive serial correlation. So I've seen that, and I have been working on how to remove the serial correlation. One of the things I've found out about removing that is to use the first different forms of the variables instead of using co-integration. Instead of doing co-integration as the main equation of the GATCH model, and thereafter testing for the existence of co-integration, I could use the first different forms of the variables. You understand? So I didn't have time to do all of this when I submitted the paper. But I knew that there was positive serial correlation, which could affect the predictive power of the models. So I've taken note of that before. Any other question? Okay. Let me quickly respond to the other questions very quickly. Yeah. The first question relates to the issue of non-application of the fiscal rule, which is a very crucial observation. But in research, we follow what we see in the literature. There are many authors in the literature who have indicated that the rule was adopted. It was enshrined into law in 2007. It was introduced in 2004 and enshrined into law in 2007 when the Fiscal Responsibility Act was introduced. So it is a legal thing. It is not just an administrative thing. It's a legal thing. If you study the budget, issues of the country, the fiscal rule is adopted. It's in operation. You understand? So I want to disagree with the fact that the fiscal rule is not implemented. It is implemented annually. Now, if we have papers from outside the country that confirm the implementation, then we cannot argue that it is not implemented. Then on the issue of co-integration, the issue of methodology that you mentioned, there is no way you can explore volatility, correlation, covariance, association between two variables without using this kind of methodology. There's no way you can. Because you have got to use the right statistical tools to explore what you see in the literature. So if, for example, I've used co-integration regression here, directly thereafter, you could see me talking about the child test of that co-integration, then the unit root explored the unit root test of the residual of that co-integration, indicating that the regression here in table 3 is not spurious. So whether you use the first different forms of the variables or you use co-integration, as long as what you have agrees with statistical theories. So I also want to disagree with the fact that these statistical tools are not proper. To the best of my knowledge, in dealing with the literature, I could see that as long as what we are doing is consistent with empirical and theoretical stuff, you can use them. It seems to me that probably you didn't explore, I'm talking about the discussant, it seems to me that you didn't really deal with the material properly to follow the trend. Then the issue of Okonja being a politician, that's not really our concern here. Our concern is to objectively deal with what we see in the literature, what we see in the statistical bulletins, what we see in the empirical literature, what we see in the theoretical literature. Those are the things we concentrate on. So I have not really brought into my analysis the issue of somebody being a politician. It's not my concern. We want to solve problems, and we can only operate within the boundaries of the materials we have in the literature. I think people are fond of saying that, Nigerians are fond of saying that some people is a politician. It's not really my concern as a researcher. Then the assumption, the question on the assumption of the real revenue and real government expenditure relationship, that is what we have in the literature. It is widely accepted in the literature that Nigeria is an oil-driven economy and that its expenditure is closely tied to the oil revenue. It is widely accepted if you read about Nigeria. So it's not an assumption. It seems to me that maybe you didn't read the literature in line with the paper to find out that that is not an assumption. It is widely known in the literature. So the use of the dummy variables and all of that indicate that that relationship has been broken. Then I've responded on the dummy stuff. Then co-integration issue, I've also responded. If you study all the co-integration regressions I've done, I have indicated that there is long-run relationship between the variables using the Eregha methodology. I know there are more advanced co-integration methodologies you could use, but here I am dealing with simple relationship between two variables for policy reasons. I am not really interested in the advanced econometrical and statistical issues. It's not that I cannot make use of some of those things, Johansen, a bond test, and all of that. But here I am concerned with two variables relating, and I'm trying to explore what happens before and after the introduction of the fiscal rule. Thank you very much.
there is need for fiscal rules in monetary unions. There is need for some fiscal discipline because if, for example, a member country has very relaxed fiscal policies and accumulates huge debts and eventually becomes insolvent, that may create externalities for other member countries of the Union. If the country goes bankrupt, then banks that hold this country's debt in other member Union countries may go bankrupt. So because of these externalities, there is need for some form of fiscal rules. But then the question is whether such fiscal rules, if they are too strict, may affect public investment, for example, by making public investment pro-cyclical, which could exacerbate volatility in the economy, or by reducing the quality of public investment by extending implementation periods of investment projects, by increasing costs, and so on. So I will focus on the evidence from the West African Economic and Monetary Union, which includes 8 countries, Francophone countries, that use the franc CFA. And I will present some empirical results, and then I will discuss the policy implications of our findings regarding the possibility of using more counter-cyclical fiscal rules, or moving toward fiscal federalism or risk sharing as alternative means of introducing some form of flexibility. But before presenting the empirical results, let me talk about some stylized facts regarding the growth rate in the West African Monetary Union, public investment, but also the asymmetry of shocks that affect the union members. Just very quickly, we analyzed basically a sample consisting of 81 countries, low income and lower middle income countries. So in that table, one main finding to keep in mind would be that average GDP growth in West Africa Monetary Union countries has been lower than in other sub-Saharan African countries, 3.7% versus 4.5%, and also lower than in other low-income countries elsewhere. Another fact that's useful to keep in mind is that public investment in proportion to GDP has been comparatively lower in the West Africa Monetary Union, 6% of GDP, and that's over the period 95-2012. About 2 percentage points of GDP lower than in other sub-Saharan African countries, and lower than in other low-income countries in other regions. So basically, first stylized fact is that in West Africa, public investment is lower as a proportion of GDP, and growth has been slower on average. Now, how about the asymmetry of shocks that affect the member countries of the West African Monetary Union, the 8 countries? One way of assessing whether shocks that affect countries are asymmetric is to look at the correlation of their GDP growth with the average of the monetary union. So in that table, we just calculated the correlation of the GDP growth rates of each member country to the average of the monetary union. And as you can see, the highest correlations are for Burkina Faso, 0.6, for Togo, about 4.5, but for other countries, the correlation coefficients are very low, and for some countries, they are even negative. Niger, Senegal, for example. On average, the correlation coefficient is 0.11, which is very low. And as a benchmark, just to let you know that in the US states, for example, the correlation of their income growth to the average of the United States is 0.7. In the Eurozone, the correlation of GDP growth of member countries to the average of the Eurozone is about 0.5. So the picture is that the member countries of the West African Economic and Monetary Union, they face frequent asymmetric shocks. And the point that I want to make is that because of this asymmetry of shocks, they need some policy instrument to be able to respond countercyclically. Because obviously in the monetary union, you cannot use monetary policy to respond to shocks, to asymmetric shocks, because monetary policy is being implemented for the union as a whole. And obviously you cannot use the exchange rate. So you need something else. Another way of checking of analyzing the asymmetry of shocks is to look at the terms of trade, whether the terms of trade that affect individual countries are correlated with the average for the union as a whole. And again, the picture is the same. The highest correlation of terms of trade can be found for Burkina Faso, 0.55, and for Benin, and also for Mali, but for some other countries, correlations are negative. And on average, you see a very low correlation, 0.2. Regarding fiscal discipline, just to mention that the fiscal rules have been introduced in the West African Economic and Monetary Union in 1994, after the devaluation of the CFA franc by 50%. So they require the member countries to meet a criterion, a target of a positive basic fiscal balance. Basic fiscal balance means that basically excludes expenditures financed by foreign investment, by foreign financing outside of the Union. There is a debt to GDP ceiling at 70%. And a third criterion requires countries not to accumulate public spending arrears. Now, the enforcement of the rule has been quite mixed. In 2012, for example, 5 of the 8 members had a negative basic fiscal balance, and 1 of the countries had accumulated arrears. But on the positive side, the debt sustainability of all member countries has been maintained after they benefited from debt relief. Now, let me come to some empirical results. Our strategy has been quite simple. We ran a regression of the rate of growth of real public investment on the rate of growth of real GDP. And we did the same for the rate of growth of real current expenditures. That's the second column in the table. And we also ran a regression for the fiscal deficit in proportion to GDP on the rate of growth of real GDP. We ran the regression on a quite large panel of up to 80 countries, low-income countries and lower middle-income countries, using fixed effects, fixed country effects, and fixed time effects. Because there is reverse causality between public investment and GDP, we used a GMM estimator. And I have to apologize actually to our discussant, because what I'm presenting now is a revised version of the paper, and we didn't have time to submit the revised version to the conference, so you have read an earlier version of the paper. Apologies for that. So we used a GMM estimator using 5 instruments, 4 lags of GDP growth, real GDP growth, and world GDP growth multiplied by each country's export ratio. All the regressions have been corrected for heteroscedasticity and autocorrelation. Now, the interesting result to note here is, and we have separated the coefficients for the 8 members of the West African Monetary and Economic Union and for the rest of the sample. So the interesting result is that, as you can see in the coefficient in the first column, public investment has been indeed procyclical in these countries. So the estimated coefficient is significant. So when GDP growth goes up, public investment accelerates. When GDP growth goes down, public investment, the rate of change of public investment contracts. So the main finding is that the public investment has been the main shock absorber in the West African Economic and Monetary Union since the introduction of the fiscal rule. Contrary to the West African countries, when you run the regression for the rest of the sample, the remaining 72 countries, as you can see in the second row of the table, the coefficient associated with public investment is not significant. So public investment has not been procyclical in other countries. What we found is that current expenditure has been procyclical in these countries. Very quickly, the fiscal deficit to GDP, it has been counter-cyclical in other countries. As you can see, we have a positive coefficient associated to GDP growth, which means that when growth accelerates, you have lower deficits or higher surpluses. So it's a positive coefficient. But in the West African Economic and Monetary Union, the fiscal deficit has been acyclical. Now, when you run these regressions for the previous period, from 1981 to 1994, before the introduction of the fiscal rule, the interesting result is that public investment in the West African Monetary Union has not been procyclical. As you can see in that table, estimated in the same way, the coefficient associated to public investment is not different from 0. So there has been procyclicality after the introduction of the fiscal rule. We did another exercise, an additional exercise, which consists basically in separating the sample in two periods, two types of periods, the good and bad times. Good times are the years when growth is higher than average during the period 95 to 2012. Bad times are the time periods when growth is lower than average, GDP growth is lower than average. And one interesting finding is that there is some asymmetry. There is some evidence of asymmetry in the sense that the procyclicality of public investment occurs in bad times, when growth is less than average. So these are the main empirical findings in the paper, and the question that comes up is what to do. Because, as I said, there is need for fiscal rules in the monetary union, but at the same time, individual countries, member countries, they need some flexibility in order to face asymmetric shocks. And as we saw earlier, asymmetric shocks are very prevalent in the West African Monetary Union. So, what are the options here? The main option would be to use national fiscal rules, which introduce some room for countercyclical response. Or, second option, which is not mutually exclusive, is to move toward some form of fiscal federalism, meaning by that some interregional transfers across countries through common taxation or through common spending programs. Or a similar option to fiscal federalism to create a form of risk sharing through solidarity funds. So very quickly, how about the countercyclical national fiscal rules? There are various options. for that. I mean, the first option is to have a target for the overall fiscal balance with ad hoc adjustments. So when a country faces a negative shock, like in the global financial crisis, 2008-2009, the government in that country would be allowed to revise temporarily the target for the fiscal deficit. The main problem with that is that that could create a problem for the credibility of the fiscal rule. Another option would be to target the cyclically adjusted fiscal deficit, the structural fiscal balance. Again, this is probably a good option. The problem in sub-Saharan Africa is that it is perhaps difficult to reliably estimate the cyclically adjusted budget balance. A third option would be to target the overall budget balance, but not on a yearly basis, but over the cycle, over a period of 4 or 5 years. This is also probably a good option, but with problems for the credibility. And still another option would be the so-called golden rule, where you exclude public investment from the target. But whatever option is chosen, two criteria would be that a good fiscal rule should provide incentives for restraint in good times, and at the same time flexibility to absorb shocks in bad times. Now, I'm finishing with the other direction, which is to move towards fiscal federalism and some form of risk sharing. Now, fiscal federalism involves establishing a centralized budget among the members of the Union through tax sharing some tax bases, or introducing common expenditure programs. The main problem with sharing tax bases is that the appropriate tax bases to share would be the personal income tax and the corporate income tax. I mean taxes on mobile factors of production. And these tax bases are quite narrow in West Africa and, generally speaking, in sub-Saharan Africa. Risk sharing can be introduced through solidarity funds, which is a form of group insurance. It could be financed either through premiums by member countries, or they could work as contingent credit lines financed with initial contributions. The main point here is that risk sharing would be preferable than self-insurance, building its own reserves to face adverse shocks, if there is asymmetry of shocks. So if shocks are very asymmetric, each individual country will need to contribute less to a solidarity fund than the amount that the country would need to save by itself. So let me stop here, and thank you very much for listening.
Thank you very much for your paper, sir. I am the one discussing the paper. I will just start by talking about some of the key things in the literature that you have indicated in the paper, one of which is the general nature of fiscal policy in developing economies. Fiscal policies are usually pro-cyclical in developing economies relative to developed economies. So that aspect needs to be dealt with based on different factors, because there are many things that constitute what we call a developing economy, not just the fiscal aspect. So we need to look at different things. Then there's the paper on, there's a paper from Tab Sober, which talks about public expedition, be more pro-cyclical in the monetary union that we are dealing with. So, you know, when we look at these two studies, we will see that the best thing to do, like I have suggested here, in dealing with the monetary union is to deal with monetary and fiscal policies that could make the union to move towards being an optimum common currency area, you know, because if they concentrate on the counter-cyclical fiscal rules, you know, they cannot capture other things that need to be dealt with to make the fiscal policy of the monetary union to be sound. For example, if you look at some of the things in your findings, you see, the elasticity of public investment with respect to GDP has increased after the introduction of the convergence fiscal policy, you know, 1995 period to 2012. And the convergence policy relates to the valuation of the currency. I know that relates to exchange rate and some other stuff. So the fiscal policy of the monetary union cannot capture what needs to be done, cannot capture everything. There's a need to look at the monetary aspect. Then another thing in your finding is that the elasticity of public expenditure to GDP is higher when the variables are measured in nominal terms. You know, that relates to price issues. And the way, you know, economies run their macroeconomic policies now, inflation issues are not just fiscal issues. They are also monetary issues. So I suggest that, you know, what they need to do in that currency, in that monetary union, is dealing with the criteria. No, it's designing policies that will make them to fulfill the criteria of the optimum common currency area, you know, and that involves dealing with all the dimensions of macroeconomic policy, fiscal and monetary. But I think I want to appreciate your contributions as regards the fiscal rules that you have indicated, and I believe your findings will be of use to the policymakers of the monetary union. Thank you very much.
Thanks, Aristomene, for the presentation. Could you pull up your slides again and take us to your, where you started to develop your stylized facts? Yeah. So when I was looking at this slide, on the positive side, it seems as though while the average growth rate in the YMO countries was lower, but the level of public investment was also lower. So from the point of view of efficiency of public investment, it seems as though they were actually a little bit more efficient. The incremental capital output ratios are higher for the YMO countries than for the others. So I wondered what that suggested. Yes, there is volatility, there is pro-cyclicality, but there seems to be slightly higher incremental capital output ratios slightly lower capital output ratios, I think, if I'm correct.
No, that's a good point. Actually, we didn't think about that. Perhaps we should explicitly calculate ICORs for public investment. But the way we see the problem actually goes in the opposite direction. That is, our presumption is that because of the fiscal rules, probably, and the asymmetric response of public investment to GDP volatility, the fact that public investment is cut more in downturns than increased in upturns, the public investment to GDP in the West African Monetary Union ends up being lower, and that lowers the GDP growth rate as well. So our presumption would be that with a more counter-cyclical fiscal rule, public investment could perhaps be higher in the member countries, and that could also boost GDP growth, and that could also be a factor to improve the prospects for the monetary union to become an optimum currency area in the future, which now probably is not the case in view of the asymmetry of the shocks that affect the countries. But it's a good point. Actually, we should check that more formally.
But then you also said at one point that they were not all observing the fiscal rules. So 5 of the 8 countries were not observing the fiscal rules. They were violating the limitations on unpaid arrears. So are they getting away with flexibility that is not in line with the rules?
Yeah, well, that's the reality in the region, that despite the fiscal convergence criteria or the rules, the rule is being violated by some of the countries. One of them has accumulated arrears. But despite the violations, public investment has been procyclical. So that's the finding. Yeah.
Yeah, I think you emphasize the point that they should allow some flexibility in times of bad asymmetric shocks. And I'm just thinking if that's not going to create another incentive to promote fiscal imbalances and indiscipline. Because here is the case that if a country is affected, or probably if there's bad asymmetric shocks, the fiscal rule is once again giving that country the option to do as it's pleasing. I don't know if that's not going to introduce some incentive on the part of some of these countries not to be fiscally disciplined.
So I'm sorry, I didn't understand. The main question is, what is the main question?
I think as part of your suggestions, you said we should allow
more flexibility
during, but I'm saying that if we introduce flexibility into it, then it's not going to create some incentive for fiscal indiscipline.
Okay, I see the point. So actually one way of doing this could be to, for example, if you introduce a more flexible fiscal rule, counter-cyclical fiscal rule, and if at the same time you introduce a solidarity fund, which member countries could use in times of adversity, you could link the two and make access to the solidarity fund conditional to meeting the targets of the more flexible fiscal rule. That could be a way, possibly, to introduce some discipline, while at the same time making the rule more counter-cyclical. But it's just a suggestion.
I'm curious as to if the level of public investment is so low in the region that fiscal rules is probably not a major impact. Because it appears to me that the level of investment as a percentage of GDP is generally low due to other internal factors. So trying to determine an adverse effect on public investment as a result of fiscal rules, I think
perhaps it is a bigger issue that we're missing. What are your thoughts on that?
Yeah, that's something that we did not investigate, because a proper way of doing this would be perhaps to estimate, a full-fledged regression to explain public investment. What we did here was to look at just at the correlations in a somehow robust way of public investment and GDP growth. And in addition to what you said, I should add that the fiscal rule in the West African Monetary Union excludes public investment financed from foreign sources outside the monetary union. So if the World Bank or the African Development Bank funds a project, an investment project in these countries, this investment project is not counted in the basic fiscal balance. And despite that, yes, indeed, the public investment of GDP has been very low. So that's something that needs more investigation. I agree with that. Probably the high level of public debt before debt relief could be a factor that was a constraint to public investment.
Yeah, thank you very much. Yeah, from your result, I saw that you used GMM as your estimation method. And one of the issues, GMM. And one of the issues with GMM or 2SLS is getting the appropriate instruments. And you mentioned two instruments, 4 lakhs of GDP growth, what GDP growth multiplied by export ratio. So the question is there any way you test for the appropriateness of these two instruments, whether they're actually appropriate to be used as the instrument? Thank you.
Yeah, thank you. I forgot to mention actually that we did the standard Hansen-J test for the validity of the over-identifying restrictions. So in our case, we have 7 over-identifying restrictions. And as you can see in the last row, the J statistic indicates that the instruments used are overall valid. Yes, please.
So does the monetary union have a central bank? A central bank for the union? Does it have?
Yeah, of course. There is I'm not sure what's the acronym, but yeah, there is a central bank for the West African Monetary Union based in Dakar, if I'm not wrong. But
I just want to know, I just want to be sure that they have, because I believe that would be very useful in building their monetary policies, like the European Bank does in the Eurozone.
But it's the same exactly design. Huh? The design, the structure of the West African Economic and Monetary Union is very similar to the design of the Eurozone. Yeah. Mm-hmm.
I think they could learn from the Eurozone.
Yeah, I'm not sure.
Thank you. My name is Nantob Yilmon. I'm come from the University of Lomé. Thank you for your presentation. My question is that, finally, quick fiscal policy you retain for the WIAMU country because of the low income of this country? My question is that I want to know finally what fiscal policy you retain for the West African Economic Monetary Union countries because of the low income of these countries. The fiscal pressure is 17 for this country, and we think that it is too high for this country. And I want to know finally which fiscal policy you retain for these countries. Thank you.
But, of course, the issue of the fiscal stance is an issue which is very peculiar, very specific to each individual country, to what extent fiscal policy should be expansionary, neutral, or somehow restrictive. It depends on the economic situation and the shocks faced by each country. But the point made in this paper is that fiscal policy should avoid making, for example, public investment a shock absorber. That's not the right, let's say, variable to absorb shocks. Public investments should be somehow divorced, to use the same terminology that our colleague used earlier, from the economic cycle and the shocks that affect countries. And fiscal policy should help somehow public investment become more stable and more predictable, and contribute to economic growth. So that's the point we make. No more questions? Thank you very much.
Okay, good afternoon. My name is Eregha. I'm basically presenting this on behalf of a friend who couldn't make it for reasons beyond his control. The topic is fiscal policy effectiveness affected by institutional setups in Nigeria? And this is the structural presentation. The author started by telling us basically that fiscal policy is highly, which has already been established, pro-cyclical, and is mainly, what triggered that is mainly from political factors, political economic factors. And predominant among these has to be resource dependence issue of developing countries, because most of these countries basically depend on resources, and this fiscal policy pro-cyclical issue basically come from their dependence on this the resource issue. And basically, in Nigeria, we basically know that one of the key problems in Nigeria is that budget preparation is basically not divorced from fiscal institutions, because fiscal institutions issues are basically surrounding the budget preparation. What do we mean? Nigeria budget is basically prepared based on oil benchmark, and political interests come into play, basically from the National Assembly, whether it should be maybe $70 per crude oil barrel or not, depending on the international oil price. I think that was what my brother was basically in the first place presenting. And as a result of that, when this government came into, when a democratic government came into place, as of 2003, oil price was prepared based on $20 per barrel. But as of 2012, it was $72 per barrel, and that is almost 260% increase. This issue of what should determine the oil price, crude oil price in terms of budget preparation has been a debate. And in fact, one of the reasons why there is delay in budget preparation and implementation in Nigeria is basically from this issue of this argument. I remember last year, one of the key issues is it should be $70 per barrel, it shouldn't be $70 per barrel from the government and at the center from the National Assembly. So what the author is basically looking into is to examine whether weak institutional setup in Nigeria, affect the quality of fiscal management in the country. Literatures were basically reviewed, and most of the literature tend to show the fact that strong institutions minimize the severity of terms of trade shocks to ensure steady performance. That as institutions are basically strong, it reduces the shocks, the severity of shocks that basically comes in from fiscal management and fiscal implementations. And basically, these studies that he reviewed were pointing to the fact that the roles of institution of fiscal policy in terms of macroeconomic stability, is germane. And it's on this note, he went to the second section of the paper and looked at stylized fact. The first graph here has to do with oil price volatility and real GDP volatility. And from that graph, basically, we could see that oil price has been volatile, and even the real GDP could also be shown to be volatile, probably coming from the oil price volatility. Then the next table is a table on state government fiscal applications. Now, the first one is federal government fiscal balance over GDP, and the second one is total own expenditure over GDP, then that of the state government. Basically, if you look at the one of the state government, you find out that for 1970 to 2009, almost all the period, that of the state government is higher, pointing to the fact that state government expenditure, maybe the state government put more pressure to the federal government in terms of fiscal responsibilities. In terms of, they put more pressure to the available revenue so that they can have a bulk of this revenue in terms of what they will have as their own to implement in their own state. So the state government own revenue in terms of their total revenue is on a high side, and that of even the state government expenditure as the ratio of federal government expenditure compared to the federal government own revenue to their GDP. Now, basically, the framework the author used is basically from two aspects: fiscal institution aspect and political institution aspect. This is basically the framework. Then he tried to look at actual outcomes and at the same time budget forecast error. And the standard error, he took standard error of these variables and discovered that the standard error for forecast error are higher than those of actual outcomes in both the deficit and output. And basically, the explanation to this is that errors that appear to be common in the budgetary forecast, and this suggests weakness in fiscal or budgetary applications in the country, that the country's fiscal or budgetary applications is basically weak. So it started with a model, and that model comes from Alessino and Tabellini model, and the dependent variable in that model has to do with fiscal policy, measured at fiscal balance to GDP ratio as the function of output gap, openness, and a measure of institutional quality in Nigeria, and then a one-period lag of fiscal policy. And another model was also estimated to look at the effect of fiscal policy on output gap. He estimated basically just a regression line comparing oil revenue and federal government spending and that of the states. And you could see from these two graphs basically that the effect basically from the state is higher, it's almost 1.1 compared to that of the government. And this tends to show the fact that the state government spend almost more than what revenue that comes to them. Their spending is, as a function of revenue, is more compared to that of the federal government. This basically points to what I've earlier said before, that the state government put more pressure on available revenue in terms of the sharing when it comes in. The same thing, this is for another period, and that is the period of the election, that is the democratic period, 1999 to 2011. And in that period, the first one was the overall period, but this one is for the democratic period. And the democratic period, the same results were basically discovered. And the conclusion of it, the tuition behind this is that democratic government even in democratic era where we expect rules to be obeyed, democratic government will also put pressure basically on the government in terms of revenue allocation to them, and they spend more than proportionate of increase in revenue in terms of their government expenditure. And that basically can be explained to institutional setup that are basically maybe not strong enough. Then the next result is fiscal policy, fiscal institutional and budgetary effect. The author looked at correlation between actual output, actual fiscal balance, balance error, and some other basic variables. And that one of the key variables is budget making period, then the early passage of the budget. And one of the key findings is that weak oil benchmarking tends to reflect imbalance error. You know, the balance error compared to, its correlation with the budgetary making period and that of early passage, you could find out that the correlation there in terms of actual output and budget making period is negative, but when you compare the balance error with the budget making period is on the high side and is positive. And the same thing, the actual output with respect to early passage of budget is 0.18, but when you compare that to the budget error, it's low. However, the conclusion basically from the author is that fiscal institutions are still not effectively isolated from oil price issues in the international market. So oil price issues still come to play in terms of fiscal institutions. So he estimated the first model, which is fiscal balance as a function of real output gap and these other variables. And the results basically show that for the O period, the effect is positive, and from 1971 to 1981, which is the pre-SARS period, is also positive. However, the effect is more. But during the pre-SARS period, the effect is negative. And during the democratic era, the effect is also positive and is more than proportionate, just like we have said earlier that the pressure in terms of revenue increase, expenditure in terms of revenue increase more than proportionate. Then the next model has to do with institutions and fiscal pro-cyclical issues. And he captured that with two main variables, fiscal dependence and fiscal concentration. And the result basically, he estimated different types of model. One, inclusion of fiscal dependence without inclusion of fiscal concentration. And the other one is inclusion of fiscal concentration without the inclusion of fiscal dependence. And the last one basically is the inclusion of the two. For instance, the first one, in the whole period, fiscal dependence is having negative effect on overall fiscal balance. And the democratic period also is basically positive. That's a positive impact. And this also points to the fact that democratic period, the pressure on in terms of increase in public expenditure in terms of the revenue increase that comes from the higher sector is more than proportionate. And one key issue to explain that is that, for instance, in Nigeria, before maybe the Nigeria Governors Forum had problem, one of the key issues the Governors Forum was fighting for was the sharing formula issue. They were so concerned about the sharing formula in terms of what gets to them, whatever money that comes in, basically should be shared, and that was one of the key things they were fighting against the federal government for. And this could probably account or explain for the intuition behind this result. Then the other model is the real output gap model, where he looked at the impact of fiscal concentration and fiscal dependence on output gap. Basically, the method for the first model is just OLS, while the second model is GMM. And here also, we could see that fiscal dependence in this model has positive impact on output gap. Then fiscal concentration also has positive impact, but the fiscal dependence has more impact than the fiscal concentration. But for the combined effect, the fiscal concentration has a negative impact, while the fiscal dependence is more. And this result basically is almost similar with what we have explained in terms of the intuition, that the pressure in terms of the expenditure of government as a function of revenue spending is more than what they could provide internally. So, in all these results, these are basically the conclusion of the findings of the author. One, fiscal institutions are rather weak, that they do not provide the expected formidable guide against Professor Eregha, that is, the institutional framework in terms of fiscal institutions are weak for Nigeria, and that still tends to react based on oil price development. You know, we depend so much on oil issues that whatever increase that comes in terms of oil price and the calculation in terms of the revenue increase play a part in terms of what should be released to basically state government, because what it captured fiscal dependence is a state government expenditure as a ratio of federal government expenditure. The influence of political factors in fiscal operations basically could be blamed because of weak fiscal institutional framework. If institutional framework were basically strong, such political factors coming to play might not be there. One key thing, even up to now, Nigeria government budget has not been really passed. And one argument of that, because the institutional framework are not basically strong, and that gives room for political interest coming to play in terms of budgetary preparations and all of that. And this account for basically the findings. Conclusively, the institutional framework of these countries need to be strengthened. This country, Nigeria, need to be strengthened. And then easy access to fiscal pool. You know, I want to just make a brief statement on this recommendation the author is making. If you look at Nigeria today, everybody is clamoring for more state creations here and there. The question I ask is that if we are clamoring for state creation, then you are thinking of having access to more of the federal government national cake. Because I give you an example. For the value-added tax in Nigeria comes from just few countries, but it goes to a pool. And because when it goes to that pool, everybody share, whether you are contributing or not. So the federal government oil revenue goes to the pool. So state governments share, whether you are part of the pool producing or not. So it does not give room for the state government to, put efforts to generate revenue themselves, because knowing fully well that if a state is created for my people, I will have access to the pool. So, and all this boils down to institutional weakness that gives room for all these errors. On that note, I want to say thank you, and your comments are welcome for the author.
Thanks for the opportunity to discuss the paper. I mean, this is a very interesting paper. The conclusions regarding the procyclicality of fiscal policy in Nigeria and the lack of disconnect between oil revenue and public expenditure is, predictable. It is expected. It is well known. But what I found very interesting is the findings concerning the impact of institutional factors on public spending, on the fiscal balance, what the author calls fiscal dependence and fiscal concentration variables. So the paper shows that the more the federal government spends, the lower the fiscal deficits. And the more, the states spend, as opposed to the federal government, the higher the fiscal deficit. It also shows that devolution of oil revenues to the states increases the fiscal deficit. And this finding is valid in particular for the last period, 1999-2011, the democratic period, if I'm correct, which points to a somehow disappointing result that democracy is bad for fiscal stability. in the sense that spending less at the federal level, more at the state level, and assigning more oil revenues to the states, as opposing to keeping this revenue at the federal level, is bad for fiscal stability. So I think that's a very interesting result and would merit some more in-depth examination. Now, the first point I would like to make is related to the measurement of variables, the definition of variables, because the regressions that the author runs are regressions of the overall fiscal balance, including oil, I believe, on output gap, total output gap, which includes the oil sector. I think it would be interesting to run the same regressions by excluding oil revenue, both from the budget and excluding also oil production from GDP. So basically run the regressions for the procyclicality of the non-oil fiscal balance to the non-oil GDP. So that would provide some better insights as to the extent to which fiscal policy impacts the non-oil revenue. The second point I would like to make is related. It's a bit more technical, related to the econometric results. To me, it wasn't clear in whether tables 4 and 5 in the paper, which present the main results, whether these regressions are simple regressions, OLS, or instrumental variable regressions. That's something that needs to be clarified, probably. Also, it would be good to present some tests, formal tests of the validity of instruments used, if instruments have been used. Also, I have a question regarding the validity of the regression on the last period from 1999 to 2011, because in that period you only have 12 observations, but the author runs a regression that includes as many as 5 variables. So, estimating 5 coefficients on 12 observations is somehow questionable, whether the results are robust enough. And finally, the third point I would like to make brings me to the beginning of my observations, that it would be good to elaborate more on the policy options for, to strengthen fiscal policy in Nigeria. What would be good incentives for the states to grow their own fiscal revenues and not to rely exclusively or mainly on fiscal transfers of oil revenues, as you mentioned, but go a bit more into the details. What would be criteria, for example, for sharing oil revenue with the states? Is there a need for formal limitations of the capacity of states to overspend, to run fiscal deficits? So I believe these are some policy points that would merit some more elaboration. Thanks.
Thank you for what sounds like a very interesting paper. I haven't had a chance to look at the paper yet. But to pick up on Aristomene's point, if your conclusion is that with the federal structure of government in Nigeria, the more the states spend, the greater the risk of larger fiscal deficits. That may well be one of the outcomes. But is there perhaps another aspect of the institutional quality, which is that the quality of public spending by the states, is it better or worse? So the usual argument that a decentralized form of government will get better public assets and public services, does that hold in Nigeria? So are you trading off the risk of larger fiscal deficits for better quality public spending? Or are you also getting worse public spending? Is that something that you might look at or have looked at? That's a question.
Thank you very much.
for your interesting paper. But I would like to suggest to the author that although he has explored to an extent the contribution of political factors to the performance of the fiscal policy in Nigeria, it may be an interesting thing to explore this more, that is to explore the extent to which the political factor affects the procyclicity of the fiscal policy. Because I could see from I could see from the content of the research and even the conclusions that you have the assertion that political factors have strong contributions to the nature of the fiscal policy. But you see, in the literature, like it has been indicated earlier, developing economies have that kind of attribute. There are some emerging markets, emerging and developing economies in Asia, for example, who have that attribute. That is, their fiscal policies tend to, go together with the direction of the business cycle. So, probably in the future, or in further extending the work, the doctor may need to deal more with that aspect. To what degree does political factor really affect the nature of the fiscal policy? There may be other factors that are not captured, because the fiscal policy of other economies that don't have political imperfections like that of Nigeria are also pro-cyclical. So maybe in the extension of the studies, there may be the need to create maybe a dummy for politics and all of that, and there may be the need to compare the case of Nigeria with that of other countries, other developing countries, so that one can really be sure of the extent to which political factors contribute to the nature of the fiscal policy. It seems, our perception of what happens in Nigeria makes us to have this idea that political factors contribute to the nature of the economy so much, and that may not be true sometimes. We need to really, deal with the facts, the data, because I believe politics is everywhere, including the advanced economics. We are political beings, but the political problems of countries vary, and we need to be careful to make sure that we don't give too much concern about it. We don't give too much space to the political factors, so that other factors can be captured in our analysis. Thank you very much.
Okay, thanks for all the contributions. I will get back to the author with some of them, but just a quick one or two. The first one, basically, whether democratic government is bad now or not. For Nigeria case, what I discovered and what the author probably is doing is that the case of Nigeria, you find out that the constitutional frame, the constitution or the rule of law, whatever thing we call it, which is an institutional issue, came from the military. It was given to us by the military people, and since then till now, some of the key issues about institutions have not been changed. One of them is this: the Constitution says that whatever money that goes into the federal government must be shared, nothing should be saved. And for that reason, the state government put more pressure on the federal government in terms of disbursement of revenue that comes to the government. So when there is an increase in revenue, you see them putting pressure, saying that even when this present government came into being and they said they want to form what we call sovereign national fund, they couldn't allow this to work. So I'm not saying that democratic is not basically, the author is not basically concluding that the democratic government is bad, but that weak institutions give room for that. That is basically what he's saying. And to the last one, which is basically we'll be looking at other factors that could account for that is a political perception. This basically is not talking about the perception. The constitution, like I said, the constitution of Nigeria is not a perception. The law is there, telling us that whatever thing that accrue to the government, and revenue is one of the major sources of government expenditure, and whatever thing that accrue to the government, the law says it should be spent. That is already a weak institutional framework. Until this institutional framework is changed, the pressure on the federal government in terms of disbursement of the revenue will be reduced. So if state governments are putting that pressure because of that kind of a law, all we need to do is basically to probably change the law. And that is why, so it's not, the author is not trying to look at it from maybe just perception. Political issues are there, but he is categorically just looking at the weak institutional framework that is in place, that is giving room for pressure coming from the state government, ensuring that whatever revenue increase that comes, they spend more than proportionate of whatever revenue that comes. So that makes them to put pressure on the federal government to disburse the funds. So whether we talk about stabilization issues or not, it does not concern them because the law gives room for them to share. So that is basically what the author is doing. But all other comments and all the comments given, I will definitely get back to the author and give to him. Thank you, and God bless you. I think the section comes to an end. Maybe we can move to other section. God bless you.